The big beautiful bill has passed, and what does that mean? Well, if you're somebody that works for tips, you're gonna love it because it was pitched to you that way. If you're somebody that listens to the financial news, you're probably indifferent about it because it does a lot of the same stuff, just a different day. Politicians have once again brought the US further into debt, continued to weaponize the US dollar, and continued with the devaluation of the US dollar. Hence, bigger inflation, and to what extent is yet to be determined. In this video, we're going to talk about how that happened, why that happened, and what to do about it. Because there's a great book that got published in 2020, 5 years ago, called The Great Devaluation by Adam Baratta, and he predicted just what's happening today. So what does that mean for you? Well, it's going to be profound because number one, inflation's going to go up. A weaker dollar means everything costs more. Think about your iPhone, your Starbucks coffee, everything costs more. And your wages are not going to keep up. Your hard-earned money buys less. While this big, beautiful bill aims for economic growth, it also poses significant risks to inflation, and it's going to compound these effects. Number two, higher borrowing costs. The dollar reserve status has given the U.S. an exorbitant privilege, allowing the U.S. to borrow money as cheap as ever. And the U.S. has been selling that debt to investors, and as those investors move on, because the U.S. dollars will not be the global currency anymore, the U.S. rate goes up as well. So the debt service goes up even higher, and the increased deficit of this big, beautiful bill is always going to intensify this pressure. Potentially, this could lead to bond market revolution and skyrocketing interest rates. Number three, reduced U.S. influence beyond all economics. And de-dollarization or devaluation is a global geopolitical realignment. A less dominant dollar means less leverage from the U.S. on a global stage. The war in Ukraine, not as important. The war with Israel and Iran, not as important. So now let's talk about what to do. What is the investor's playbook? What are the right things to invest in? Because as the dollar gets weaker, other things become more valuable. Real estate investors know this, gold investors know this, and most every investor knows this or should know this. Number one, precious metals. Gold bars, silver coins, those are the greatest hedge against inflation because it's considered God's currency. Central banks are buying gold at unprecedented rates, over 1,000 metric tons annually for the last 3 years. This is signaling a loss of faith in the fiat currencies, particularly the global currency, the US dollar. And gold maintains high liquidity and is universally recognized. Jim Rickards calls it the everything hedge. Silver, while more volatile, can offer even larger returns during inflationary periods. Michael Burry famously said that he would buy a bunch of nickels because zinc was a bigger return than the S&P 500 was for a period of time. So invest in precious metals. Number two, global diversification. Reduce single currency risk by investing outside dollar-denominated assets. This means foreign stocks, foreign bonds, and even foreign real estate. Institutional investors and family offices are already hedging against a weakening dollar. This strategy provides resilience against US-centric downturns. Number three, my favorite, is real estate. Anything tangible or hard assets like real estate, they've always been a huge hedge against inflation. As construction costs go up, property values go up, and some commercial leases even have inflation-linked rent increases. And real estate offers both income and capital appreciation, providing a solid store of value. A great investment, so stick with real estate. Number four, energy and critical commodities. This is where Zoltan Pozsar's Breton III thesis comes in. He argues that in a world of geopolitical tension, commodities are collateral and collateral is power. Physical resources like oil, natural gas, and especially critical minerals like lithium, copper, and rare earths are becoming the new source of financial and geopolitical power. These are the backbones of the 21st century technologies and investing. Here's the thing, you don't have to take my word for it. I'm just the messenger in outlining how we like to invest. Ray Dalio, the founder of Bridgewater and Associates, built his all-weather portfolio to perform consistently across any economic environment. Growth, recession, inflation, deflation. He learned his investment strategy from historical currency devaluations like the Nixon shock of '71. His portfolio aims for a balance of 40% long-term, 30% stocks, 15% intermediate bonds, 7.5% gold, and 7.5% commodities. It's about structural resilience, not market timing. Dalio himself has warned that the big beautiful bill could lead to big, painful disruptions for all American families and the global financial system due to the soaring debt and potential for monetary invention and intervention that devalues the dollar to essentially zero. Jim Rickards is bullish on gold and has a very passive-aggressive portfolio. He's a former CIA advisor and advocates for the passive-aggressive portfolio designed for financial chaos. He views gold as the everything hedge, performing well whether the economy collapses or rebounds. His allocation is 30% cash to buy everything he needs, 10% gold for the ultimate safety, and the remaining 60% in diversified tangibles like residential real estate and high-grade bonds. He is less enthusiastic about an overvalued stock market. Zoltan Pozsar, Bretton Woods 3, while not a portfolio manager, Zoltan from Credit Suisse, he's a strategist, has a thesis that he could define investing. He argues that the freezing of Russia's reserve marked the end of Bretton Woods 2, a dollar-centric system, and the beginning of Bretton Woods 3, a new global monetary order centered around commodity-based currencies. His core idea is commodities is collateral, and collateral is power, means money. This means physical resources become the ultimate source of financial and geopolitical power. For investors, this implies a strategic imperative to own commodities, especially critical energy and minerals. Peter Dietra, another investor, echoes the urgency. He states that the de-dollarization and the devaluation of the US dollar is not a matter of if, but when. And he warns that a sudden decrease in the dollar demand could trigger hyperinflation. Social instability in the United States, and his perspective reinforces need for investors to prepare for potentially chaotic transition by focusing on tangible assets, especially given the increased fiscal pressures from legislation like the Big Beautiful Bill. Now let's talk a little bit about what we're going to do to hedge against this devaluation of the US dollar and go into what we think might happen or what we expect to happen. So currently we're doing two things. We're buying gold and we're investing in cash flowing real estate and other hard assets. We're still investing in value add projects as well, just for the sheer fact that that's what we do best. Stay tuned for what could happen potentially with the cryptocurrencies alongside the gold markets and the silver markets and with all other precious metals. So subscribe to keep watching videos like this, sign up for our newsletter on our website, and stay informed, of course. And as always, this video is for educational purposes only. Talk to a financial advisor, a CPA, or however you manage your portfolio, because the de-dollarization and the devaluation of the US dollar is real. It's accelerating and you don't want to be left behind.